Hi, and welcome to the Millennial Money Canada podcast. I'm your host, financial planner Guillaume. I'm joined by Sam, also financial planner at Millennial Wealth Advisors. If you're new to the podcast, welcome. And our goal is to help you make sound investment and financial planning decisions and gain the right educations to be able to make those decisions. Again, what we share on the podcast is not advice. It's to highlight topics that we think are really important for you that you should learn more about that can make a difference for you. And today's topic is around CRM3. And Sam, I'll turn it over to you about, the highlight of research, or at least the why is it important and why should people care about this like at this time?
Well, I think Canadians are going to be getting a bit of a surprise in January of 2027 because they're going to look at their investment statement and see their fees double. And a lot of them might wonder what the heck's going on, right? And while it looks like, their fees are going to have doubled, it's not actually the case. What's happening is right now there's, some mandatory disclosure requirements of how much fees you're paying, but it's only part of the actual total fee that investors are paying. So in 2026, now dealers are going to have to report on client statements the entirety of the client's fees that they're paying. And this is going to ruffle some feathers, and it's going to stir the waters of a lot of these, a lot of advisors that are unprepared. Because if you're a client looking at your statement and maybe your advisor hasn't told you about the fees that you're paying in 5 years, you could look at your statement and see like $10,000, $20,000, $30,000 in fees that you weren't aware you were paying. And so that's a big, big deal. And it's important to know that it's not a new fee that you're going to be seeing on your statements, but it's a newly reported fee that's always been there.
Let's go back a little bit here in terms of kind of the evolution of like where we were and where we're heading starting in January 2026, or more specifically January, February 2027 for the client themselves.
Mm-hmm.
But CRM3 is going to be calculated or implemented, so to speak, starting this January, but clients will only see it in January 2027. So there's kind of a year there, I believe, of where all the investment dealers will get on board and get familiar with the new disclosure requirements, and then it will be out to the clients. But let's talk about, CRM1, I don't even remember when that came about, but CRM2 was already like 9 years ago. Is that correct?
Yeah, CRM2 was 2016. That was actually when I was first getting into the industry. So I really haven't known any other kind of disclosure. But yeah, CRM2 is 2016.
Right. So right now, since CRM2 at least, the only thing that clients are seeing on their statement is the advisor fee, not the product fee.
Okay, so kind of, right? So they're seeing advisor fees plus trailing commissions plus administrative fees charged by the dealers. So whether you're not, there's different types of funds that you as an investor may find yourself in if you work with a financial advisor, right? There's like A series mutual funds, there's F series mutual funds, there's exchange traded funds. And right now, all you're going to look at your year-end statement and see is the trailing commission portion of A series mutual funds and the advisor fee portion of F series investments that you hold with your investment dealer. So in the way you find that out is just look at your statement and you can see the name of the fund and it'll say usually A series or F series on your statement. And so you can tell what type of funds you're invested in. So that's what's reported now. So any compensation going to the dealer. So like, most mutual fund dealers are set up on a grid, meaning if I charge a 1% fee and as an advisor, I'm not necessarily getting paid 1%. I could be getting paid as low as 50 basis points, like 50% of the advisory fee that I charge, all the way up to like 95% of the advisory fee that I charge, right? So it will disclose the entirety of the amount going to the dealer as well. So it's not just what the advisor is getting paid.
Right. Okay.
That's what's currently in place.
Right. Okay. No, that makes sense. And then the biggest thing that the client, and you've alluded to that already, but the biggest thing for the client themselves is right now, they can see, just to keep things simple, that their advisor is getting paid 1%. That's being disclosed. But what they're not seeing is the investment product fee underneath that, that is not being disclosed. So depending on what the client is invested in, that's the portion that will now be highlighted. That will now, the light is going to be pointing right at this number. And then you can have advisor, depending how they run their practice, they can put you in, let's say an F series that has, is above 1% plus their advisor fee. So now you're at least above 2% between the advisor and the investment fee. And then you might have other advisors like ourselves, for example, where we lean more towards like low cost solutions around 30 basis points. Then you'll see that as well.
Yeah,
exactly. You're not
seeing
that discrepancy right now. You're not seeing that differences.
I think that's correct? So. Yeah, that's correct. And so I think the bigger sticker shock is going to come on A series mutual funds, because most people who are invested in F series, I think, and obviously I haven't looked at data on this, but I would assume that most people invested in F series understand at least that there's two sets of fees going on there, right? There's the advisor fee, and then there's the product fee. It's technically called the MER, the management expense ratio. But with A series mutual funds, it's all bundled into one fee, right? So it's not as transparent what part's going to the advisor and what part's going to the product manufacturer or the fund company. So if you're like invested in a Fidelity A series fund, you don't necessarily know how much Fidelity is getting paid versus how much the advisor is getting paid. Now you will. So, and in 2016, the requirement was at least transparency on the dollar amount your advisor was getting paid. But because it's all wrapped into one fee, now you're going to see the entire thing actually represented. And the example I've given on social media just to kind of describe this is like, if you had a $500,000 portfolio and you were, let's say, invested in an A series mutual fund or a portfolio of A series mutual funds, and your fee was about 2.2%, you're going to right now see on your statement an advisory trailing commission or a trailing commission charge of about $4,000 or $5,000. Okay. And a lot of people might think that's like the entirety of the fee that they're paying. But in 2027, after it's been implemented for a year, you're going to get a total year statement of the fees that you're charged. And that will actually jump to $11,000. So you're looking at, like, today, you think you might only be getting charged $4,000 or $5,000, but in reality, you're always getting charged that $11,000 on a $500,000 portfolio. So you really have to like understand the totality of the fees that you're paying now. And I think, as you pointed out, like, yeah, even though we're using low cost funds, one of the priorities that we've implemented for a long, long time is total cost disclosure, where we literally will just walk new clients through, like, hey, you're at this level. This is our advisory fee. This is the product fee. This is it in dollars. This is it in percentages, and have them essentially sign off on that before they even become a client. So we're not anticipating any issues with this, but like, I'm assuming there's going to be a lot of firms that probably didn't do that are going to have some uncomfortable conversations and have to really prove, like, hey, what's my value here? What's my value proposition to my clients? And even rethink that themselves.
Mm-hmm. Yeah, that's a great point. I mean, how many times have you heard that, or from a client that, I pay any fees.
Yeah.
And I'm like, well, yeah, you just don't see them, but you are. But that's a great point, right? When you start paying, let's say, $10,000, $11,000 for a portfolio, and you've never, let's say, had a call, have no financial planning, let's say returns are, again, but below what you can get, on your own, or using a diversified solution, then you're going to start asking question, okay, well, what's the value am I getting for the fee, and like, what am I getting in return? And then hopefully that's gonna, do you think that actually is going to spark some, I would say, motivation from people to change? Do you think that's going to be enough to entice people to look around?
I do, for like the percentage of people that weren't aware they were getting charged. I'll give you an example. Like, when I first started in this industry, and I realized that, like, when you're first insurance licensed, and I was told I have to get the clients to sign a commission disclosure document. and understanding that like, hey, I get paid commission to sell insurance, I was scared to death of putting that paper in front of a client because they're going to be like, oh, why would I want you to get a commission? You know, it's all self-interested and all this. So I was scared to death. So like disclose how I actually got paid here. And I'm like new to the industry. So I was like 21 years old. Right. So, but like there's this like idea, I don't know where it comes from, but financial advisors are kind of nervous to like tell clients how they get paid sometimes. And so it's a lot easier if clients just think, well, someone else pays them somehow and they don't actually figure it out for themselves how the advisor gets paid. And if they don't ask as much questions, advisors, you know, good advisors don't do this, but some advisors might not be as forthcoming with disclosure as they should be. Maybe it's newer advisors, maybe it's advisors that weren't trained well, or maybe, you know, a less charitable interpretation would be advisors who are looking to maybe pull the wool over their eyes of their clients, although I hope those are few and far between. I think with those people, there's going to be some churning of you know, client assets. But there was an interesting study done. So Dr. David Lewis was part of a study in North America where they looked at basically investors who and trust levels with advisors. And they found that investors who didn't know how much they were getting charged because it wasn't clearly disclosed overestimated how much they were getting charged. And so people who don't actually know the fees that they're paying will likely overestimate the fees that they're paying. And when they have it in real dollars, yes, it presents the opportunity for the clients to question the value. But in more cases than not, they found in this survey and study that it increased trust to know how much, like transparency increased trust to know how much they were getting charged. I think it'll be also a kick in the pants for advisors. There's no hiding behind opaque reporting anymore, right? Like you have to now like go out there and say, man, my client's going to look at their statement. What the heck did I do for them this year? You know, so you're going to really have to work for the clients. And I don't want to cast a bad light on the advisory industry. I think most advisors do great work for their clients. I think though, you know, for the few that don't, this is going to be a kick in the pants to either, you know, you got to start doing stuff. And, you know, for those who maybe haven't communicated their value propositions well enough to their clients, you really have to define that now.
So who do you think that is? Who do you think CRM3 is for? Do you really think it's for, and you know, to protect investors and shine the light on areas that were like pretty murky before, like or not disclosed? Or do you think it's, you know, for advisors to step up their game?
I'm curious what your thoughts are on that.
Sometimes I think I think it's equally, right? I think they're trying to bring up the transparency and build trust, and which is a great thing. I think to me, it's kind of common sense in a way, like disclosing where disclosing every fees that someone has been charged for a service, whether, you know, they're paying it directly or indirectly. I think that's just common sense. But like you just said, I think it's as much as it is for advisors. I think it's going to, and I don't like the word like clean up, but it will definitely force advisors to step up, like you said, their value proposition, their offering, revisit how they structured their, their firm. And so a subsequent question to that, I don't know, do you want to give it a stab? What do you like?
I think there's, you know, investors and like, I think industry advocates have been like demanding transparency from fund companies, right? And from dealers. And so, and I don't think you can expect most dealers to be more transparent than they need to be, right? I think that's just the dirty truth. Like, you know, you're not going to disclose more information than you're required to disclose. But industry advocacy groups have been, or like client advocacy groups and consumer advocacy groups have been really, I think, hammering this issue on transparency. But there's been studies that have been commissioned, right? Government studies. There's a behavioral insights team in the UK, and they produced reports for CRM2 and the OSC in 2019, and for the MFDA in 2021. And they found that fewer than 1 in 5 investors could identify the type of costs included in their fee summaries, right? So like there's an obvious lack of ability from clients. These statements are getting way too long, way too wordy, way too complicated. most people, really don't care to look. Um, and so, and then one of the other things was CRM2 as well. What was this? I'm just looking at the report here. So most investors report some satisfaction with how fees are reported on their financial statements. Only 67% of mutual fund and ETF investors state that they are somewhat or very confident about their knowledge of the fees they pay in MERs or about the fees they pay to their advisor or dealer firms. And so there's still like 33% of people who really don't know what they're getting charged, how they're getting charged, what that looks like. And even the 67% like are somewhat confident, so
Yeah.
so there's a lot of issues there, and I think a more informed consumer is better. And you have to, like, one of the things about like a developed country is you have to maintain trust in the financial institutions. You have to. And so if there's poor regulatory oversight, opaque reporting, clients don't know what they're getting charged, no competition, like we're that's not trademarks of a developed economy, right? So we need this type of oversight and reporting. It's been a long time coming. I'm glad it's here, and it'll be interesting to see the kind of the fallout from it.
Yeah, no, for sure. There were two webcasts that I tuned in this year, one in June and one was 2 days ago by Vanguard, and they've done like a really good job at kind of highlighting, the intricacies of CRM3. They've also shared like a simple statements, what it's gonna look like, and then there's one ratio that I actually really like. It's called the FER.
Yeah.
It's called like fund expense ratio, and it's gonna basically be broken down into the MER, management expense ratio, and the TER, trading expense ratio. So I think that's great enhancement,
Hmm.
fairly straightforward to understand, and again, shine the light on an area that like wasn't really fully disclosed before. So,
Do you know
yeah,
what I
or
love?
maybe even understood. Yeah.
Yeah, well, that's entirely right. Like, but do you know what I love? I think most about this is that seg funds aren't exempt from this.
Mm.
So so now, you can't really hide behind the opaque reporting of segregated funds anymore. So I think when DSCs um, left the picture, there were some advisors that all of a sudden became advocates of segregated funds. So for those of you who don't know, deferred sales charges, or DSCs, allowed advisors to earn commissions upfront on their um, on the purchase of new funds. So if it could be 2 to 4% depending on the type of funds. So if you invest 100,000, your advisor's getting a $2,000 to $4,000 commission. But that was mostly done away with in 2016. Not very many, again, but I saw some advisors all of a sudden switch to selling segregated funds because segregated funds didn't have those same restrictions, and you could still earn a commission up front. So sometimes when there's regulations put forward in the investment industry, the insurance industry doesn't always follow suit. But this, they are. And so segregated funds, you can't hide behind those to not report their fees. So everything's going to be on the table and fully reported here.
Segregated funds, I always find them fascinating. Sometimes like especially if you look at like long-term horizon and the statistics of like just even having a portfolio being up, like you're paying a
Yeah.
really high fee for that like guarantee, whether it's 75 or 100. And then the
Yeah.
other thing is like, what a great deal, paying 50 or $75,000 in extra fees to save about 10K in probate fees. I mean,
Yeah.
it depends on the estate, of course, but I'm just saying like,
Well,
yeah, there's a lot of bells and whistles that I really find extremely questionable. But again, it's always case by case. I'm sure there are cases where you have the right profile, the right client profile
yeah.
that is really suited for that. Maybe it happens that a lot of people who we work with are just not really suited for these type of bells and whistles, right? They wouldn't necessarily benefit from having them. So,
I heard someone tell me one time, and I really respect this person. I'm curious what your thoughts are on this. They kind of made a case for segregated funds in very niche situations. We're maybe getting a little off topic, but that's fine. So one of the situations was if you wanted to take a really concentrated risk in, let's say, a pretty risky investment, like let's say in energy, right? And you really wanted to like go in on energy, but you wanted to mitigate some of the risk. Segregated funds are a way to do that. But I think there's probably,
that's
you
interesting. I
know,
never thought about that. Yeah.
cheaper ways to do that as well, maybe. Um,
it's kind of a recreated way of, depending on someone who, like, we don't have the license, but if someone had the license for
Yeah.
options, for example, like you could basically have a similar exposure by, by being long a certain security and then being also long like protective puts or something like that, or
Yeah.
yeah, like some put options that would protect your downside, or some sort of kind of like combo strategies there. But I guess that's another
Yeah.
way to probably implement something, but it's pretty
Yeah.
esoteric as well, right? Like,
Yeah. And then it's also like, why would you want to do that? I mean, maybe you're really convicted in that, you want to take a bet, but you don't want to, lose a bunch of money. I mean, we don't advise on those types of strategies. Like if a client came to us and said, I really wanted to take a big leap of faith in this industry, we would probably tell them like, good luck, have fun on do that on Wealth Simple. We're not going to do that for you. I think the other case was a corporate securities and creditor protection in segregated funds. Which I would have to like look into, because I wonder, I feel like that the corporate veil has probably been pierced with segregated funds before. I can't remember if I've heard that before, but I want to look into that, because I don't know if that's a legitimate like argument
yeah.
for this. I've heard it before, but sometimes, you hear things being thrown around and it's not always, it's a story, it's a myth. I don't know if that is. I have to look into that, but that's another one I've heard before. But outside of those two things, like I've had people tell me, yeah, my advisor recommended segregated funds in my RSP for probate, fees waived. And I'm thinking to myself, you don't need probate costs. You don't, your RSP doesn't need to go through probate, because you can name a beneficiary on it and the money can go directly to them. So like there's,
Yeah.
some,
I think
yeah.
I think it all comes down to bring back the conversation to like the topic of today. Ultimately, it's going to entice hopefully investors to look at, again, the value that they're deriving for the fees they're paying,
Yeah.
and the higher the fee, the more that the value being derived is going to be questioned. Is it there? So another question I have for you is, who do you think is going to survive, or I would say no, who do you think is going to thrive in kind of this new environment?
Well, I think it has to be the advisors that have already disclosed their total fees and clients stick with them because they see the value. And then in my head, I have this, hypothetical scenario playing out of a client that we work with, and someone they know is like, hey, did you know that I was getting charged this much money on my investments? I had no idea, but like I just saw my year-end statement, and the guy was like, yeah, like we knew that the whole time. It's like, yeah, but the guy hasn't called me in a year, right? Like, why am I paying these fees? So I kind of have that conversation, a fictional conversation floating through my head sometimes. But I think it's important for people to understand, just like from a literacy perspective here, the new fees that are being disclosed are not fees that your advisor gets paid. So the fees that are currently being disclosed are what your advisor gets paid, the ones that have been disclosed since 2016. So when we're talking about this thing from like a holistic, what value add am I getting? The value you should be questioning, if you haven't questioned your advisor's value already, then you shouldn't be questioning their value necessarily after this new report comes out, because it's not like they're getting paid this money that you're going to see on your statement now. This extra money is going to the fund companies. So the real value that you have to question here is, and this is where it gets a little bit more nuanced, you have to go back to your advisor and ask them, hey, I'm getting charged X amount of dollars. Maybe it's 0.5%, maybe it's 1%, maybe it's $5,000 or $10,000 to invest in this. Can you just explain to me why we're invested in this? And I think that has to be the conversation that's being had. I'm not here, like arguing or advocating for clients to always like, bug their advisor about why this fund isn't doing as well as this fund, because that's a nightmare to deal with, right? But if your advisor has you invested in, high fee, actively managed mutual funds, a reasonable question to ask is, are there lower cost alternatives that have done just as well? And I think that's a pretty reasonable question to ask if you're looking at your statement and seeing, 1% extra in costs that you didn't know you were getting charged before. So I think that's maybe an important nuance to this whole conversation.
No, it's a great nuance, but I think from an investor point of view, I'm assuming that a lot of people will see this new disclosed fee, not only that it's going to the advisor, but it's based on the advisor's recommendation, because ultimately the advisor put that portfolio in front of them. So to your point, and this is great. None is going to question the integrity of the advisor. They will just want to have more clarity and understanding as to why have you suggested this type of portfolio?
Yeah.
And are there any other solutions out there?
Yeah. What do you think? I'm curious to your thoughts on this. Like, if you're a client, like, what do you think a good fee would be? Like a reasonable fee would be? Like, I have my thoughts on this, but what do you think a reasonable fee would be? Maybe even a firm that maybe doesn't share our exact like philosophy on investing. But where do you sit with that?
Well, I mean, I think you have to take a step back here, and we'll adjust the fee in a second. But I think, of course, it's I mean, okay, let's take a step back here. When you talk about fee specific, like from our point of view, we deal with like the fund companies themselves, and then a lot of common kind of discussion. It's around like they tell us like, hey, what's your fee budget? And because on the institutional side, what they call a fee budget, and then they'll basically allocate depending on the portfolios. Like, is the portfolio exposed to like the broad market? That's called beta. Then you don't want to pay a lot for that. And then there's another side called alpha, meaning that you're expecting your managers to outperform their benchmark. Then you want to allocate their fee to that. But whenever I have someone from the investment side asking me, "Hey, what's your client's fee budget?" in my head, I'm like, it's zero. Like there's no like fee budget. But I understand where they're coming from. But on the retail side, like, if I would ask a client like, "Hey, what's your fee budget here?" and they'll probably say like the lowest possible or something like that, right? Like, so what I'm getting to is, I think it's going to be interesting but I don't even think clients even understand the conversation because most people don't understand like what they're paying for. So from my point of view, what I think is a reasonable fee, well, to answer your question, what I think is a reasonable fee is what I just mentioned. If you're able to basically separate the fund performance, and then you need to understand, okay, what was the investment methodology that derived this performance?
Yeah.
What's at the essence of how the money is invested? You start there. And then you're able to evaluate, okay, what have I been paying for? I mean, the investor doesn't have a clue about what I'm talking here, but if they had a clue, this is the questions they should be asking. And then what I think a lot of people will realize is that 90% of the investment industry have been paying really high fees for what we call beta, for what you can get for like basically 6 or 9 basis points. And this is the problem. And then they're still fund outperforming. Now, to trying to identify which funds will outperform, all kind of stuff. I mean, this is a whole rabbit hole. I don't know. I don't think we can get into this into this conversation, but I think these funds, whether you can identify them in advance or not, I think these funds will always have like assuming you can identify them, will be worth paying for, assuming that they're able to deliver in their outperformance. It's just almost impossible to identify beforehand. But that's my long answer to what is a reasonable fee. Well, if your client is invested in those closet indexers, and you're being charged 2.5% at in a Series A mutual fund, and you can basically get index ETF like for 9 basis points, then I think that's outrageous, right? Now you want to pivot the conversation to the value side, and this is kind of where you get into the planning side. And now your next question might be, well, how much is planning worth? And this is where we can open up the conversation, right? Now, how, is it a fee only, advice only, fee only? Is it embedded with AUM? And there's a whole lot of discussions in there.
Yeah.
I still believe that, like, how we run our firm, and we're extremely transparent in our fee, that the approach that we've taken, even though we're doing a lot of planning work, and all my conversations are around planning, or my quarterly meetings are around planning. And yes, we talk about the portfolios if the clients have questions, and I highlight the things that they should be aware of. There's still a model where it's beneficial for the client to even pay an AUM fee, even though the service is highly based around the planning side of things. I don't think you need to be advice only or fee only if you are a financial planning focused firm. But again, that's up for debate as well. So it's going to be interesting to see who thrive in this environment, right? But if I had to do one prediction, I think not everyone, but I think a lot of people, like you said, that let's say have been paying, a pretty high fee, who are somewhat DIY or kind of tuned into personal finance. I think you'll continue to see that massive shift towards the Wealthsimple of the world and the self-directed side. But then a lot of them will also repivot, especially if they are business owners or their situations get complex. And then they'll end up in a world where, oh, I never knew about financial planning or how extensive it was. And now the two worlds will kind of bridge again. And this is where we're at. We're like, well, this is the service we provide you. This is the value we add through the investment and the planning side. And this is kind of the fee we charge. And this is where all the worlds will kind of meet in the middle. But I think that trend is just going to accelerate. But at the same time, I think a lot of people will literally do nothing and just continue as is. So yeah, that's that's my prediction of the future.
Yeah. Okay. There's a lot there. I think if we want to go back to like that first point of what's a reasonable fee, if I understand what you're saying correctly, because I want like, the average Joe investor to have a takeaway from that, because I think that was really insightful, was that you might be paying, and so I actually did a LinkedIn post about this a long time ago, but it was basically like the idea of you paying for a personal training fee, but them never telling you that you were paying for a personal training fee. And so essentially you thought you were just getting a regular gym membership and didn't know it included personal training, but you were really overpaying for what a regular gym membership actually was, right? And so this whole idea of you might be paying for something that's not actually delivering what you're paying for. And there's a much cheaper option. There's the, Anytime Fitness of the worlds. There's the Evolution Fitness of the worlds in the investment context, right? Like where it is $15 a month and you have unlimited access to the gym. So just to kind of break down that analogy further, you're saying clients are paying for something called active management, but in reality, behind the scenes, for whatever reason, one reason or another, maybe the fund got too big, maybe there was just never any real conviction to invest it in whatever way, they're really getting index fund performance minus exorbitant fee to pay for index fund performance, when they could basically go and cut that fee from 1.1% to 0.09% and get the same performance, if not better. But they think they're paying for something different, but they're actually not, right? So that's kind of where clients are at. Is that what you're saying?
Yeah. So if clients wants an actual answer, like the 1% plus, depending on your asset level, of course, but if you have, let's say, less than $1 million and you pay around 1 to 1.25% plus whatever portfolio you're invested in, so you should be around I would say around 1.5 at most. I think if you're paying more than that, I think you may be overpaying. And then as your wealth goes up, then that should trickle down somewhat over time. But yeah, so if people are still in the
1.5%.
I think that's a reasonable fee. I think if you're still in the 2.5, 3, which a lot of people are, I think you're, and now, like, again, it's all about without sacrificing the returns. And then we don't know what the future, but I posted a kind of a screenshot of, you know, a lot of the funds that we recommend, which are globally diversified, factor tilted, and like one sleeve, the Canadian Vector Fund, 30 basis points, up 23% average annual return for the past 5 years.
Wow.
8%. Like, I mean, like, if you have a private equity fund charging you, let's say with the performance fee and all that stuff, like 4 or 5%, like, and they're delivering anyway 20 to 25%, like, you're talking like similar returns at a fraction of the cost for a vector. Again, now you're talking about a very specific country, Canada, a specific, you know, tilted portfolio, which is vector, which has
Higher
like
risk.
exposure to higher risk securities. But this is like a portion of your portfolio. That's not like your entire portfolio. But the point is you're getting what I would characterize as stellar returns for like very low cost, like 30 basis points. Man, that's like that's low, you know? So for performance fee, I mean, so sorry, for management fees, investment management fees. But yeah, anyway, that's kind of like the story. I think public markets have been rewarding investors plenty to allow them to meet their goals. And I've just never done a plan for someone where they require to be in certain investments that are much more expensive because they couldn't meet their financial goals based on the solutions that we have that are low cost. And this
Honestly,
is one of the
if anything, it would be the opposite, right? Like if anything, it would be the opposite. If anything, it would be like, hey, you know, by paying these fees, this will inhibit you from hitting those goals. So maybe you'd want to consider not doing that, buying VEQT or XEQT on Wealthsimple, right? Like, and by the way, like any products we talk about here, we're not recommending. They're not right for everyone, right? So you guys, you know, you do have to get qualified professional advice. I just want to throw that disclaimer in there. But yeah, just generally speaking, like we know this. We know that fees are one of the best predictors of future expected returns. Morningstar's done research on this. There's very few predictors of expected returns, but what one of them is the fee. And the higher the fee, the lower the expected return. And so if you're looking at your fund and you're seeing a percentage, if you're in F series, if that percent is, let's say 0.5% or higher, okay, or if you're A series and that percent is 2% or even 1.6% in total or higher on your total portfolio, then it's worth having a conversation with your advisor. Because armed with hopefully this data, the stuff that we're providing for you here today, you know, you can say, hey, I heard two guys, maybe they know what they're talking about because one's a chartered financial analyst and a CFP, the other's a CFP, and they have their own investment firm. They told me that fees are the best predictor of returns. And the lower the fee, the higher the expected return. So can you explain to me why we're in these high fee funds and what they're doing for me that a lower fee fund won't do? Your advisor should have an answer for you.
And it's contradictory. It's contradictory to anything else in life. Like Ferraris cost more than Honda Civic, right? And you know, you want a custom home, it's going to cost you a lot. It's going to cost you a lot more than an older home. And so on, right? Everything you think that higher price is better. That's the economy we live in. That's the world we live in. But in the investment side, it's probably one of the only area where way of thinking does not apply, which is so counterintuitive. Paying more for something doesn't guarantee you better, and that's what you mentioned with the Morningstar report. But it's very counterintuitive.
Yeah,
I want to shift the conversation, unless you have something else to touch on this one. But I want to shift the conversation around trust. I'm not saying that what we've talked about doesn't matter, but how much? And we all know that we're in a business where it's all about trust. And I have a story about this. I was at the doctor's office yesterday, which I want to shaft him, but it's all about trust. So at what point do you think that those initiatives, which are great, by the way, we all agree that it's better for the investor, better for the advisor, better for the industry, better for the country, right? And at what point do you think it's irrelevant? Because the trust level is so high that clients, there's no there's no fee that will ever change their mind, make them question the value or anything of that sort. And I have my own opinion on this, but I want to hear yours.
Well, I would say, I think there was the IFIC investor confidence surveys that came out and said that like 92 to 95% of Canadians trust their financial advisors. That's a high number.
That's a high number. Yeah.
That's a high number. I was surprised to see that number. Well, trust is everything, but it shouldn't. It's funny because it trust but verify, right? That's the old saying, trust but verify. A lot of people trusted Bernie Madoff. You know, a lot of people trusted, Jeffrey Epstein. A lot of people trusted these guys that were in the finance industry, financiers, whatever you want to call them, only to find out that they were complete crooks, right? And so trust matters, but it shouldn't, there should still be a verification process. You should still check to see that your advisor's registered. You should still, if someone's claiming to be a CFP, verify their CFP. It's an easy thing to do. You type their name and find a financial planner tool on FP Canada's website. You check the Canadian Securities Administration's NRD database, search their last name. Do they show up as a registrant? Search FISRA's find a agent tool for your mortgage broker or your insurance agent. And this doesn't mean they won't give you bad advice, but doesn't matter if they were recommended from a family friend. You still need to verify, their credentials and who they're licensed through and all of those things. So this, I would take the position on this matters because clients need to have financial empowerment. It's not enough to just have financial literacy, because you can know that your advisor charges you fees, but not really necessarily take any action on it if they're charging you too much, because you don't feel like you have the tools or resources available to you to actually make a difference there. But if you have the empowerment, the ability to actually make a change, and know the types of questions you should ask, you should have a great trusting relationship with your financial advisor. But you should also be asking for the logic behind their recommendations, and they should be able to show that to you. That's as simple as that. You don't need to understand their job. You just need to understand why they're recommending something to you. And so I don't know, it's a tough question, man, because trust is important, but so many people have gotten away with such bad crimes because people have trusted them. So I don't know. What do you think?
Yeah, I know. So you're raising great points, like what you said about verifying the person's integrity from a licensing standpoint, registration standpoint. For sure, I think I wasn't necessarily going down. Sorry, I thought that was table stake. I wasn't saying that to question this. I was going more in terms of like we just talked about today, questioning when all the fees are going to be disclosed, how much people will actually, how much is it going to actually move the needle? Because my view is that especially the wealthier they are, and of course the deeper the relationship, but the wealthier people are and the deeper the trust, I feel people are extremely fee, how do you call it, intolerant or fee?
They have high fee tolerance. They don't care.
The fee level is almost a non-conversation. They will,
you have a
and
point.
I'm not saying they will pay anything, but they will never. And I want to give you an example. This is a slightly kind of tangent, but it's kind of related to this. But I was at the doctor's office and they were late. So I was waiting and there was this lady beside me. She was probably easily in her 70s or 80s. Super with it. Anyway, we talked on the conversation about, actually, we ended up talking about investments, but she almost got scammed. She was talking about a scamming a scammer that reached out to her and they wanted her to show up to the bank and take out e-transfer $50,000, and there was this whole thing which I thought was yeah, I mean, we see that, right? But it's super unfortunate anyway. And we ended up in the conversation of investments. And of course, I share I'm a financial planner, and I'm like, who do you work with? And then she says, oh, I work with this firm, which I pull my phone up, and it's a stock picker in Toronto. So classic, stock picking firm, investment management firm.
Yeah.
And so and then this lady, of course, like that kind of generation, they've been raised, like they know very little about financial planning. They've been raised about, like the stock picking. That's all they know, right? And then we went into this rabbit hole about, like, she's like, oh, they're amazing because, I'm always watching the news. And then whenever I ask questions, oh, why am I holding this stock in my portfolio? Like, it's been on the news lately. Like, what's the rationale and all that stuff? And then I kind of was sitting there for a second and like thinking about kind of, her train of thought. And I was like, okay, well, I want to go down that rabbit hole? Do I want to start having this conversation?
Yeah.
But she said one thing that like really, I guess, solidified my thought was, I've been with them for, I think it was like 30 years something. And they've made me, they've been really great to me. Like, and I could, just in that sentence, like I could sense like the level of trust over time that she had built into them. And of course, with the returns and stuff, like there's nothing that would ever kind of displace that. And then of course, in that case was like, and then that's where I kind of sat down and I took a deep breath and I was like, okay, what do I do here? Do I want to go down to say, well, if you look over the 30 years, you can look at market beta and they you could just, you could have done as well in other solutions as well. Or maybe, if you actually had like what you've had plus planning, maybe you could have had like this, this much more, or maybe this much more peace of mind and all that kind of, and then I was like, you know what, Guillaume? Just leave it at that. So I asked her, hey, what's your favorite stock? And then we went on that, discussion. But I think my point was, a person like this, whether it's a high fee mutual fund, whether it's a stock picking strategy, you name it, I think because the trust and that generation is so deep, I don't think any amount of disclosure will ever change things. But again, I might agree with you. I might be wrong.
No,
but
I agree with you.
But then the younger investors and the more cost-sensitive investors and people who don't have as much wealth, I think they will by far be the ones who will hopefully take a lot more actions from that type of disclosure.
Well, I think we want an environment where clients trust their financial advisors. I don't think anyone's advocating that, you shouldn't trust your financial advisors. And look, the reality is like we follow evidence in our mutual, like in our investment philosophy and in our portfolio management philosophy. Not everyone believes in the evidence that we follow. Some people have different opinions on it, right? It's pretty clear to us. It's pretty clear to the entire evidence-based community, but not everyone follows that. And they have a right not to follow that, right? And if they're being forthright about their investment strategy with their clients and clients believe in that investment strategy and want to follow them on that, and they trust their advisor, then that's good. Like that is, maybe the $10 million client could have had 12 million. Like who cares in that aspect, right? Like as long as they don't care, right? And that's where it comes down to like, you should trust your advisor. Like, so I agree with you there. It probably would not have been a good idea to try to displace the trust that lady had in her financial advisors. Because if they've been working with her for 30 years, and who knows, maybe they were the ones that caught the scam. Maybe they were, you just don't know the whole story there. But look, as long as your advisor's not being fraudulent, as long as they're disclosing things to you, as long as they're being transparent about their philosophy, they have a philosophy. Like we believe that the lower the fee, the better. Well, we know lots of great advisors that love alternative investments that are charging 3% and 4%. Like it's not our cup of tea, but so you just, so it's important to have that conversation, but it's important to also, I'll place that caveat there. If your advisor has a philosophy that you buy into, they should be able to present the why behind it if they can, and you're agreeing with that. There's nothing wrong with like working with that advisor. So that's not, we're not trying to like displace trust in the financial advisors here. I just think that, maybe fewer advisors than most people think will actually have good answers to the question of, can you explain to me why we're invested in this instead of, Or is there an option with a lower fee? I don't want to leave your services, but like, I'm just curious, could you provide me with like potential lower fee portfolio options? And it's also important, like if you're the client here, you can know that like that's not going to affect your advisor's compensation to ask them for lower fee portfolio options. So there's not going to be a conflict there for the most part either. So anyways, just a bit of a tangent there, but it's important stuff to know. And I think you hit the nail on the head. Like some people are going to be okay paying higher fees because they feel taken care of. Now, even if the higher fee they're paying doesn't go to take care of them,
Yeah.
they still feel like, well, it's trust with the advisor. They recommended it, so I'm good. And look, as long as your advisor's trustworthy, then that's a great relationship to have.
Yeah. No, one last comment I would say make to kind of conclude this episode here is when I was chatting with this lady, and it's not necessarily related to fee specifically, but it's more like the investment philosophy, which we kind of touch on in today's topic is the fee matters, but it's more understanding the investment philosophy behind the fee that you're paying. And if people can get educations around that, I think that will give them a lot of clarity into justifying that fee. But when I
Yeah.
was chatting with this lady, one thing that I thought was fascinating was, and this is the difference between someone who believes in, let's say, the power of markets or understands that, hey, being maybe globally diversified to an asset class, you don't have to be invested in very specific securities to do well over time and to meet your goals. But I was thinking about just from a peace of mind perspective, imagine being in your 70s and 80s and you're stressing about the stocks that you're holding in your portfolios. And every quarter or every month, you tune into the monthly calls from your stock picker. Every quarter you question why do you hold that stocks? Why is it important? Like that's the type of relationship and that's the type of worry that you're carrying. And I was listening to that and I was like, wow, you know what? Like I didn't say anything, but it doesn't have to be that way. It doesn't have to be that way. And that's really where I kind of like it reinforced essentially like once you understand kind of the power of markets, once you kind of I would say moved to an evidence-based philosophy, and then once you understand the drivers of returns, man, that the amount of peace of mind that comes from that, let alone the fee. Fee sure is important, but I mean, what is that worth?
Yeah.
And this is just a choice of how you want your money to be managed and how you want to live and what you want to spend your time on. But I don't know, to me, that was, yeah, well, again, maybe it's a different generation. And it all comes down to like your financial education. If people is tuned into personal finance, they will meet at some point, what is index funds, what are factor-based funds, and then they'll usually meet a financial planner along the way. But yeah, anyway, that was kind of like my one of the biggest realization I had in our conversation, which
Yeah.
it just really reinforced that I think the way the service we provide and the advice we give, it's in like, let alone the fee itself, from a peace of mind perspective, a reassurance, a confidence that people are on on track to meet their financial goals without relying on speculations and predictions of a future. I mean, how much is that worth? So
Yeah.
yeah,
I think
that's it.
to close here, we know it's been researched that fee transparency increases trust. It doesn't decrease trust, it increases trust. So that relationship that you're nervous about with your client, be transparent about it. There's going to be an increase of trust. And so that's why we're not worried as a firm. I'm not worried. I don't think you're worried. Part of the reason is because we've always disclosed total fees to our clients. It's been something we've believed in as a philosophy since we teamed up together, right? Like clients need to know what they're paying,
You
and
showed me that. Yeah, you showed me that.
yeah,
And in our intro call, usually after I send you we have a PDF of an overview of the firm, our services, our pricing, and everything is laid out, like the advisor fee, the
yeah,
different fund management fee, the different fund options. You want a low cost fund at 9 basis points. You want a factor tilted funds at 30 basis points. You want a sustainability fund at 32 basis points. And then the next slide is literally showing you in dollar amounts, whether you have 500,000, 1.5, 3 million, 5 million, how much is
yeah,
that costing you in like dollar amount? And that's sent to you from the get go. So
Yeah.
I love that, and you showed me that, and yeah, I'm very thankful of that. That we established
Yeah.
that. It brings a ton of reassurance, and yeah, and hopefully it's building trust from the start, right?
100%. And so, yeah, if you guys want to see our offering, you're more than welcome to reach out to us, and we'll provide you the link to our service offering, and you can, we can have a conversation about if that's something you're interested in. But
Of
no,
course.
this is cool. This is good. This is important. It's coming right around the corner. January 2027 will be the first statements that clients will see with their actual total fees reported on it. It's been a long time coming, and it's finally here. So yeah.
I'm excited to see who's going to take actions from that. What are, who's going to be, yeah, who's going to be, I would say benefiting from that, but yeah, who's going to be moving or making decisions based on that. It's going to be very interesting.
Mhm,
So
mhm.
I'm sure we'll revisit the topic when it's published.
Yeah,
Right. And
exactly,
the first
exactly.
statements are
We'll have
out.
more.
Yeah.
Yeah, yeah.
Yeah.
This is how to
Yeah.
read. Maybe we'll do like a podcast on how to read your investment statements, and we'll go through
That
like,
could,
hey, this is what this is, And so if you're interested in that, let us know. We'll craft something in the next year.
yeah, of course. Well, with that being said, we'll see you in the next episode. Thank you for tuning in. Bye bye.